Global markets are facing growing uncertainty as inflation remains stubbornly high and central banks struggle to balance economic growth with price stability. Over the past year, the cost of living has continued to rise across many countries. Food, fuel, housing, and transportation expenses are putting pressure on households, while businesses face higher production costs and tighter profit margins. For many families, this means changing daily habits, buying less, saving more cautiously, and delaying major purchases. For businesses, higher costs reduce margins, limit expansion plans, and increase the risk of layoffs, especially in sectors like manufacturing, retail, and transportation. In response, central banks such as the US Federal Reserve and the European Central Bank have raised interest rates aggressively. Their goal is to slow demand, reduce inflation, and stabilize prices, but these measures also risk slowing economic growth. Higher interest rates make borrowing more expensive for both consumers and businesses. Mortgage payments rise, credit becomes harder to access, and companies delay investments or hiring. Over time, this slows economic activity and increases fears of a recession. Financial markets react quickly to these changes. Stock prices fluctuate, bond yields shift, and currencies move based on expectations of future interest rates. Investors closely watch every inflation report, jobs data release, and central bank statement for signals about what comes next. In the worst-case scenario, inflation could remain elevated while economic growth weakens, a situation economists call stagflation. This combination would make it extremely difficult for policymakers to respond, as cutting rates could worsen inflation, while raising them further could deepen an economic slowdown. However, there is also a more optimistic outlook. If inflation gradually eases and supply chains continue to normalize, central banks may be able to slow or pause rate hikes. This could stabilize markets, support business investment, and restore confidence among consumers. There are already early signs of improvement in some areas. Global shipping costs have declined, energy prices have stabilized in several regions, and manufacturing activity has begun to recover in parts of Asia, Europe, and North America. So what should investors, businesses, and everyday people watch next? First, inflation data will remain the most important indicator. A sustained decline in prices would signal that policy measures are working. Second, labor market trends will be closely monitored. Strong employment supports consumer spending, but excessive wage growth can fuel inflation. Third, central bank communication will be key. Even small changes in tone, from tightening to holding or cutting, can shift global markets instantly. In addition, geopolitical developments, energy markets, and global trade conditions will continue to influence inflation and economic stability worldwide. Ultimately, the global economy is navigating a fragile transition period. Decisions made today by policymakers will shape financial markets, business strategies, and household finances for years to come. This report is based on analysis from the Federal Reserve, the European Central Bank, Bloomberg, Reuters, and the International Monetary Fund. If you found this analysis helpful, subscribe to World Business Explained for clear, reliable, and timely global business news, and stay ahead of the economy.